Hi, Jim Gore from Thor Wealth Management. Want to give you an update on what we're doing here at Thor and summarizing some of the things that we've talked about the last several months. First of all, let's start off with the THORdex. The THORdex is our measure of risk out there in U.S. stocks. And 50 is kind of the midpoint. And if you're above 50, it's a little bit more expensive. Where we are right now at 80 means that the U.S. stock market is very expensive. We're not as expensive as we were in 1999 according to our analysis and our proprietary index, but it is expensive. Notice back in March when it did fall, we did put some money to work, but we didn't back up the truck, but we did put money back into the market, and it was an opportunity to maybe make some money at that juncture. Notice in 2009, that was a back up the truck moment. The THORdex was below 10, and putting money to work was pretty much like shooting fish in a barrel. It was very, very easy. But another indicator that some people look at is the Warren Buffett indicator on the market valuation. And this is looking at the market capitalization of the U.S. stock market compared to GDP. And notice on this one, we are at all-time highs. And we think ours, the THORdex, is a little bit more robust, but this is just showing another picture of how expensive U.S. stocks are. So because U.S. stocks are expensive, we want to be underweight U.S. stocks overall. But where do we go to find values out there? And I'm just summarizing what we did back in the past. This is looking at MLPs. And if you go back to our October market update, we were pretty much pounding the table on investing in MLPs. And MLPs so far this year are up over 50%. But we think we're still maybe in the early innings, maybe the third, fourth inning of the game right now. Because if you look at the price to discounted cash flow, MLPs are still selling at a valuation that is lower than the historical average. And they're also paying out a very good yield right now compared to other investments. You can get an 8 to 9% yield on the MLP space. So they're still offering value. And if you haven't invested in MLPs, you still have some time for this to grow because you're still buying it at a valuation lower than historical average. The other area that we're finding value in is in international securities. And this is just looking at the forward PE ratio of the U.S. market versus Canada and EFA. And if you look at this index, the U.S. or the PE ratios, the U.S. stock market PE ratio is much higher, 30, 40, 50% higher than international. And in some emerging markets right now, the PE ratio of those markets is about 1/3 the PE ratio of the U.S. market. So the two things are going to possibly happen with this. Either the PE ratio of international securities is going to go up to equal the U.S. market, which means that they're going to have appreciation, or the U.S. market PE ratio is going to fall to be in line with the international markets. Also, keep in mind, international markets are behind us with COVID. They're just getting their vaccines. So this is a great opportunity if you don't have money invested in international securities, especially emerging markets, and we like even more the emerging market small company stocks. So there is opportunities, even though our THORdex is saying that the market is expensive, it is telling us to not look so much in U.S. stocks, but look in other areas for investments, and we are finding that in MLPs and in the international equity markets, especially the emerging markets. We take care, and if you have any questions, as always, reach out to us, and we'll talk to you in a couple weeks.